Well, this has got to be a new one. In a note released on Tuesday, a Bernstein strategist says the rise of passive investing is, quote, worse than Marxism. Interesting comment. Does he have a point? Welcome to Trading Nation. I'm Brian Sullivan. We've got Max Wolff of Manhattan Venture Partners, Erin Gibbs of S&P Global. Erin, I don't think I've ever seen worse than Marxism in an investing strategy piece before. Regardless of one's views, perhaps, of Marxism, what do you make of the comment on passive investing?
So I don't view it quite as negatively. I really, in fact, not remotely as negatively as the analyst. I really view this more as the popularity of ETFs, the change of investor preference going from they used to be stock pickers to more of an asset allocation. And so I don't view passive investing as negatively as this analyst might. And we really see that when we look at institutional ownership. We've seen a steady rise of institutional ownership along with these passive ETFs. And we have seen increased popularity in asset allocation models. And so these ETFs are those vehicles where you can more easily switch from, let's say, equities to fixed income using an ETF versus actually trading a full basket of 100 stocks and then shifting from there. So I just see this as more a reflection of moving from stock picking to asset allocation for a lot of financial advisors and the retail investor having less ownership in those individual names.
Although, Erin, I will say this. I don't know the exact numbers, but I'll go out on a limb and make a guess, which is probably going to be true, which is with the proliferation of ETFs, there's probably nearly as many ETFs as there are stocks. There's at least as many mutual funds and ETFs together as there are stocks. So doesn't that in some ways make it almost just as difficult to pick a winner than just randomly picking a stock?
Oh yeah, it's challenging. I'm just saying, for me, it's more this is the preference of investors going from stock pickings to asset allocation, and certainly it may be more challenging to pick your winners, but it is easier to control your risk from an asset allocation standpoint and really reflecting what your risk is versus getting into those individual and tend to be more volatile names.
Max, I just can't go back in time and picture Karl Marx arguing that something was worse than passive investing. I don't think the reverse would have happened. Is passive investing necessarily a bad thing?
No, but it probably needs to be seen as not a panacea. So obviously I don't share quite this revolutionary or counter-revolutionary zeal with the analyst here, but look, there are some pitfalls to ETFs, and I think maybe one of the lessons is you still do have to keep in mind that there can be commissions, and commissions on ETFs, if you're putting in a small amount of money, can affect the return as much as the lower expense ratio, one. And two, when you buy ETFs, you still have to know what you're doing. You still have to have a portfolio theory, and you can't just sort of blindly buy ETFs and get the best of a mutual fund with also a lower expense ratio, especially if they're passive indexes. So you still have to have a core theory. You still have to have a thesis. You still have to adjust that thesis. You still have to have a risk budget. And so to whatever extent there's some rationality behind the rage there, I think that the idea might be that ETFs are just inherently a panacea and always better than mutual funds. And of course, that is a little bit overdone.
Yes, as an active portfolio manager, I would like to point out there are those of us who do have good track records.
Well, there you go. And by the way, I was just looking here. ETFs, obviously now a $2 trillion industry. 231 new funds were added last year, just through 3/4 of the year, which is the last data we have. So basically, a couple hundred new ETFs every single year seem to be created. Erin and Max making some good points, and at least an entertaining note from that Bernstein strategist. Guys, thank you both very much.